This episode of the Matt Feret Show is brought to you by the Brickhouse Agency. Brickhouse is a boutique independent health insurance agency that focuses on finding the right Medicare coverage for folks across the country. Matt's wife, Nikki, is the heart behind Brickhouse. She's great at making confusing things clear and is passionate about helping people find a Medicare insurance policy that suits their individual needs. To schedule a free one-on-one appointment with Nikki or a member of her team, head on over to brickhouseagency.com or simply call 844-844-6565 and someone will help you schedule a phone call or a Zoom meeting. The consultation is free because the insurance companies pay Brickhouse, not you. There's never any pressure or obligation to enroll. Your clearer, simpler Medicare journey is just a call or click away. brickhouseagency.com. Not affiliated with or endorsed by the government or federal Medicare program. Contacting Brickhouse Agency, LLC will direct you to a licensed insurance agent.
Hello, everyone. This is Matt Feret, author of Prepare for Medicare and Prepare for Social Security Insiders Guidebooks and online course training series. Welcome to another episode of The Matt Feret Show, where I interview insiders and experts to help light a path to successful living in midlife, retirement, and beyond. Welcome to The Matt Feret Show, practical conversations to help you thrive in midlife, retirement, and beyond. I'm Matt Feret, author of books and courses on Medicare and Social Security, and a former healthcare executive with decades of insider experience. I use that experience to help people make clearer, smarter decisions about health, wealth, lifestyle, and caregiving. Each week, I sit down with experts, insiders, and fascinating people to explore what it really takes to thrive, finding purpose, building stronger relationships, and creating a sense of meaning and community in the second half of life. Together, we'll light the path towards your wealth, wisdom, and wellness. Welcome to the conversation. Hey, everybody. My guest today focuses on something most people underestimate when it comes to money. Not what we know, but how we behave. He's the founder and CEO of Fusion Family Wealth, a fee-only registered investment advisory firm based out of Long Island, New York. His work centers on helping people make better financial decisions under uncertainty by understanding the emotional, and psychological biases that quietly drive poor money choices. Rather than chasing headlines or reacting to markets, his approach is about discipline, temperament, and sticking to a plan, especially during stressful or uncertain times. He's widely recognized for his work in behavioral finance and has spent more than 2 decades helping individuals, families, and professional advisors understand why smart people still make bad money decisions and how to change that. My guest today is Jonathan Blau. Jonathan, welcome to the Matt Feret Show.
Thank you, Matt. It's a pleasure to be here with you today.
For people meeting you the first time, tell us what you do and how long you've been doing it and how you ended up focusing so much of your work on behavior and decision-making, not just investments.
Sure. So when I started in the wealth industry, it was the summer of '87. I was an intern at Lehman Brothers that went out of business during the financial crisis after over 200 years being a successful company. And I was it was 55 Water Street down by Wall Street. And I was a young kid in with these 20-somethings that were all previously salesmen, top salesmen at companies like Xerox and IBM, and Lanier Products was a big copy machine company. And they had the top sales training programs. And so they came in and they were stuck in a closet for 4 months to study for the Series 7. Usually takes 4 weeks, but took these guys 4 months. But they were great salesmen, and that was their training program. And so that's how I first got introduced into the business. But the business back then was cold calling wealthy people from cards you bought from Dun and Bradstreet with their backgrounds and their wealth levels, and you had a whole what they called a pitch book with rebuttals, a rebuttal book, and when I did that for a couple of summers, I said that's definitely not what I want to do. I did get on the phones and help the those days they were stockbrokers do it, and they were all young millionaires. You know, they're the very best salesmen. And so after that experience, I decided that I wanted to go into this business, the wealth management business, but not that way. I wanted to learn the technical aspects that wealthy people deal with and then go into the wealth management business the right way. So I joined Arthur Anderson after getting a master's in tax and MBA in accounting from Fordham University at Lincoln Center. And I learned everything from trusts and estates on the tax side of things to retirement planning on the tax side of things. And then I joined what was then the largest privately owned money management firm in the country, which was called Sanford C. Bernstein. Now it's Alliance Bernstein. They merged in around 2000. And so what happened was when I started my career with Bernstein, it was 1997. I was in a training program for 6 months. I raised, I don't know, $50 million or so in the first couple of years. And then in 2000, it went down in half because of the dot-com bubble bursting, combining with the terrorist attacks. And then I rebuilt to over 100 million by 2000 and 6, 7, and then it went down 60%. So it went down to 40 million because we had the credit crisis. So in the first decade or so of my career, we saw something that happens once or twice in 100 years happen twice in less than 10. And so I said to myself, there's got to be a better way to manage client relationships and a business than walking the same people off the same cliff today that I did last month, last week, and yesterday. And so in the first kind of month of training at Bernstein, we had been introduced to behavioral finance, and I kind of put it in the back pocket in my brain. And then one day after the 2008 crisis, my second real crisis in 10 years, I said, I got to do something different. So I realized that the answer to successful investing for investors doesn't lie in intellect, what we know. You can study PE ratios and betas and alphas and call the ABC as alphas, betas, and correlation coefficients, things that mean nothing to investors and really to me either, as an advisor. But you can study those all day long. And the key is no matter how smart you got, when the crisis hit, you still, in 2008, was selling some or all of your equities in fear of existential threat of the financial system collapsing. And you did the same thing in 2000 to 2002 after the dot-com bubble burst. So I said, there's got to be a better way. And the better way was, I remembered from Bernstein, teaching people the lifeboat drill long before the bow of the boat went near going beneath the water. And so that's how we got into behavior. And we wanted to help people understand that it's not which investments you have. You could have any investment going into 2008. If you were a CEO or someone who inherited money, someone who had a PhD in finance or never went to school, no one was less likely than the next person to sell everything out in existential fear. It's again what you do, not what you know.
That's a fascinating background, by the way. I mean, and I was trying to do the dates in my head too. Yeah, you saw a lot over those
Quickly.
years, very quickly. And those are big numbers moving up and down, and it gave you certainly a really interesting seat to where we are today. Meeting. You mentioned the phrase, and I did too, wealth management, and immediately this doesn't. People think it doesn't apply to them. Well, I'm not wealthy. How do you explain what you do in a way that connects with everyday people who are saving, investing, or approaching retirement?
Sure. So yeah, we cater to investors who have 5 million or more in liquid investments, but the principles that we use to help them to succeed apply to everybody. So we can apply what I'm going to say to everybody, regardless of what level of wealth. In other words, everybody who's worth 5 million, and everybody who's worth of 5,000, right, is a human being. And so we all respond to fear and greed and envy and regret and uncertainty all the same way, right? It doesn't matter how much money we have. It's just the consequences of letting our behaviors and our emotions take over our decision making are more costly when we have more money and less costly when we have less money. That's all. So we can address the broad audience with these ideas.
Yeah, why is behavior such a dominant factor in whether people succeed or fail financially?
Yeah, well, and I'd say not just financially, like to succeed or fail in life. So basically, to think about it, the human brain hasn't really developed that much in the last 50,000 years. Meaning, we were programmed with biases or tendencies to protect ourselves without much thought. Our what I call the emotional intelligence, just react quickly in order to survive life and death threats from the lions in the African savannah hundreds of thousands of years ago. We were not programmed to survive the vagaries and uncertainties of the financial markets and decision making about finances when they collide with uncertainty. And so not only were we not programmed properly for these things, but the way we were programmed to survive in the African savannah is often the opposite of how we need to be programmed to survive now. So I'll give you a quick example. In the African savannah, we were running from a bear in the woods because it was a permanent life and death threat. And at the base of our brain, the organs that are the fear sense is called the amygdala. And the amygdala doesn't know the difference between the permanent threat of the bear in the woods or the temporary threat of the bear market. It sends off the same danger signal and sell now and ask questions later. That's the worst way we could be programmed to survive financial decision making. And there's so many biases. There's something called loss aversion bias. So again, that helped us survive in the savannah. We feel the pain of a loss 2 times more than we feel the pleasure of an equivalent gain is pleasurable. And we're programmed that way so we can seek to avoid losses and survive as long as we possibly can that way. The problem is now we're still programmed that way. And as an investor, when I should be seeking out strategies that maximize the potential income stream I'll have when I retire, so I can retire comfortably and stay comfortably retired, and that maximize my wealth to the extent whatever wealth I have, maximize it. Instead of seeking those strategies out, we're programmed to seek out strategies that are the opposite, strategies that minimize the short-term chance of loss and that maximize the quickest route to pleasure. These are the opposite things of what we need to survive financially, but they perfectly protected us from the threats that we were programmed to be protected.
Thank you for that. Yeah, someone introduced me a long time ago to the concept of your amygdala being hijacked, a
The
hijacked
amygdala
amygdala.
hijack. Now, was that Doug Lennox?
I don't remember who it was. I mean, this is going back years and years and years. But was it one of those self help books or the
Yeah, it could. Doug Lennox, an author, and he's a friend of mine. He's 73. He was the advisor to the CEO of American Express, which was during 9/11. He was the guy who helped Ken Chenault get his whole firm back on track. And Doug, I know, wrote about it, and one of his mentors, I think, might have coined the phrase "the amygdala hijack," but it's in his book that I recently read
really?
because he sent them to me. And the funny thing is, we were just talking about it. He was on my podcast about 2 months ago, and one of the ways you help yourself to fight these biases, the emotional biases from taking over, Doug created a system called the 4 R's. So the 4 R's stand for recognize. So when he says recognize, you're recognizing how you're feeling at the moment that your emotions are taking over, whatever the situation is. How are you feeling? What's going on externally, internally around you? And then so you recognize. Once you recognize, you reflect on what's happening, right? And then what values do you have that should guide your decision, not what emotions? What's most important to you at the time you're feeling these things as far as your goals? And then reframe. How can I view the situation differently? And then respond. So, what that 4 R's does is it slows and prevents sometimes the amygdala hijack because it stops it. So by not making that quick decision, by going right into the 4 R's, recognizing, reflecting, reframing, responding. So the example Doug gave me, which is a fun one, he said, Winnie the Pooh left his house. He's walking along, looks at his shirt. He says, I don't like this shirt. But then he says, geez, now I got to go all the way back home. So he said, instead of changing his shirt, he changed his mind. That's an example of the 4 R's. And so he rated and said, I value more not having to go back home. So I'm reframing. The shirt's okay. Changed my mind. I'm going along my day.
That's funny. What you just described though is you have to be aware of it, number one, but then also you have to take action or do something with it. You have to actively recognize it and then respond in a way that's methodical. And I think I want to draw that parallel to this concept of intelligence. And everybody hears, IQ or emotional intelligence, or how many degrees or certifications or training you have. But you've said this already, and you say it in other places, that investor temperament matters more than intelligence. And I would imagine you might also say that intelligence can actually be worse than, if you think you're smarter than everybody else, you might make even worse decisions around these emotional times, and temperament matters. True, false?
Yeah, it is true. I mean, I wrote a piece that Barron's published in the middle of 2020 that highlighted the self-published um, uh, investment habits of what's called Tiger 21, which is arguably the world's wealthiest investment club. Many billionaires among them. I think it's 35,000 a year now to join. And they published every quarter what, as a group, they were doing with their allocation. So, as a group, when we were 12% cash, now we're 16 this quarter. We were 10% hedge funds, and now we're 5, so on and so forth. And what I was able to prove, and that's why they published it over dozens of quarters of their own publications, is the very wealthy make the same mistakes as everyone else, but they do it with two big differences. They do it with a lot more confidence and a boatload more money. And the first part that I mentioned addresses your question. It's called overconfidence bias. So the more successful someone is in their own field, the more they feel they can succeed in any other field with their hand involved better than the professionals can. And so when they do that, it's like taking a big magnifying glass over the biases that we all have, and they don't realize, So in that regard, there's a guy named Morgan Housel who writes the best psychology of money books, and he always says that a good definition of behavioral finance is when you're reading about big mistakes that people make with money and finances and investing, and you think you're reading about other people, but you're really reading about yourself. You just don't accept it. And the wealthier we are, the less we accept that we're human, and that human nature is immutable, and it affects us as much. And as you say, because of overconfidence bias, is what you were describing, affects us even more. And the penalties are greater for us if we're wealthy. And then one other concept that's good to just know about for the audience, it's called epistemic trespassing. So when you have someone who's a successful entrepreneur and they've been wildly successful, they opine to people on about other fields as if they're expert in those fields, and they're called epistemic trespass. They're trespassing into some other field that they have no experience in, but because they're so successful, they pretend to. And listeners to this podcast should realize I have found in in the old days I used to say I found no correlation between wealth and wisdom. But I now say it differently. Often I find there's a negative correlation. The wealthier they are, the less wisdom when it comes to money and investing, not everything else they have. And the more they pretend to have and like the sound to have. So, said differently, I've met a lot of wise people who don't have a lot of money. And I've met a lot of people with a lot of money who, when it comes to managing money and investing, are not.
Wow. And you wouldn't think that, but I think we would all relate to the concept that you mentioned, which is, smartest guy in the room, just ask him. And that, the guy who
Right.
made the Amazon buy in 2002, and just held on, and all of a sudden now he's, wildly rich. Now he's going to tell you how to run your life, right?
Exactly, and oftentimes not a very good investor,
Yeah.
outside of his business or her business.
Yep. Interesting. So, in your experience, what you're talking about too is like some of the the smartest people may not be, and some of the smartest people in terms of wiseness, may not be the richest. Is that because, where does it meet? Does it meet in the middle? Is it because people lack information, or because of how they react emotionally? Why have you found that to be the case?
I think the wise person understands, because they're wise, what their values are and what makes them happy. And I forget, there's a famous philosopher or somebody who made a list of the top 10 things that make people happy, and money wasn't one of the things on the list. And so when we use external benchmarks to measure our happiness, meaning I'm going to take my family to a hotel. I've got a family of four. What's important to most people is we want to have enough space in the rooms that we have and so forth. But that's the internal benchmark. That's what I value. But many people will make the decision that I just described on the external benchmark. I'm going to squeeze into a one bedroom in a Four Seasons because then people will think I'm wealthy, right? Because I'd rather be uncomfortable in a smaller room than I go to the Marriott and have a bigger room because I'm now going to appeal to my external benchmark. So a lot of times what we don't realize is when we're chasing things, whether it's a new car, a new home, we get the thing, and then if we're not happy, we're still not happy. That thing doesn't make us happy because what's happening is we're just craving more dopamine. So what happens when we're getting a new car is we get that dopamine rush anticipating the purchase. Once we make the purchase, it goes away, and we're still however happy we were before the car, we're just as happy or unhappy after. And now we want another dopamine rush, so we'll get another big car or another big house. And so the wise person recognizes that's not what makes me happy. What makes me happy is family, charity, doing good things for other people in general. And that's the difference, right? So it's not about smart. It's about wisdom. I've always said that we're living in a world of tremendous information age. And it started with the internet, what I democratizing what I call data, right? You can get all the data you want. And now the AI is democratizing knowledge. But the thing that's still not democratized is wisdom. Data isn't knowledge, and knowledge isn't wisdom. Wisdom comes from having a lot of knowledge that you've applied successfully to gain successful outcomes for you and other people, in my mind. And so it's not, I don't think it has to do with how smart someone is or not. It has to do, I think it starts with what your values are. And again, I think wise people might tend to have better values.
Really, really interesting perspective, and I like it. You used a word, I'm going to use it back at you, crave, right? Dopamine crave. I think people also crave certainty, especially around money. And you talked about it earlier. People get scared, if they've got some bucks, no matter how much, 5,000, 5,000,000, they don't want to lose it, right? And so what might have gotten them to that 5,000 or 5,000,000, you know, you don't want to lose it. So especially around money and retirement and the future, why is that search or that craving for certainty actually dangerous when it comes to financial decisions?
The first reason is because you're chasing something that doesn't exist anywhere in nature, all right? Certainty. I tell everybody that the one defining characteristic about the future is there are no facts about it. It doesn't matter if you're hearing someone on CNBC with a PhD in finance at Goldman Sachs as a managing director says it, or if someone who is in junior high school says it. Neither of those people has one more fact about the future than the other, or than either you or I have. And so people need to understand that, given that as a fact, that there are no facts about the future, we have to learn to operate rationally, right? So everybody wants certainty. In order to succeed, we have to first accept that certainty doesn't exist anywhere as a condition in nature. And once you accept that, say, okay, so what is acting rationally? I like to say in life, again, money, life, it's all the same to me. I like to teach my clients to compound rationality, not just compound money. And what I mean by that is, just a simple recent example, someone sold their business, said, well, we have $10 million, Jonathan. Shouldn't we wait and invest it like periodically over a period of months or even years? And that's, that's of course very seductive, right? Because you feel, well, what if I put it all at once and it goes down? And so those decisions, when I say compounding rationality, over since 1926, there's, I think, well over 1,100 12-month, what they call rolling periods. So from January 26 to December of 26 would be one of those. February 26 to January of 27 is another one, and so forth. 75% of those periods, the stock market's shown positive returns. So every time I hold back a dollar that's ready for investment, the evening it's ready, I take a 3-to-1 odds bet against me being right. Right. So always invest the money by nightfall of the day you get it to invest. And 25% of the time you'll be wrong, but 75% of the time you'll be right. And so that's compounding rationality, right? You don't have certainty. So take a look at what's probable, and always base your decisions, knowing I might be wrong sometimes, right? I might invest my business money that I liquidated in February of 2020, right before a 34% unprecedented 33-day decline. But then again, if I had invested it right before that decline, by the end of the year, I still made 18% in total return. Had I not invested it because of my theory, well, what would happen is I said, well, gee, now maybe I'm glad I didn't invest all of it. I'm just going to wait this thing out. Well, from like April to the end of the year went up 60, 70%, something like that. You didn't have a chance to get in. So now you're sitting with a real permanent loss because I'd rather catch a 20% or 30% temporary decline than miss out on any portion, the meaningful portion of the next 100% permanent increase. And that's the way people need to train themselves to think. That's compounding rationality.
Hmm. I've heard of the concept of dollar cost averaging, which you were discussing, and I think that's the first time I've heard it put the argument against that
Yeah, I'm
put
not
so
against
succinctly.
dollar cost averaging. In other words, if you've got a young person, I believe in teaching them a good habit. Save every month, I tell them, $100, 1,000, whatever you can afford. Get into the habit of saving into your investment portfolio so you can compound at somewhere in the 8 to 10% range over your lifetime, and get it done early. If someone's parent says, "What's the most important thing I can teach my child about investing that's going to yield the best result to their overall long term result?" Is it start early. That's the save as early as you get. Start saving as early as you can. Compounding does all the heavy lifting. It's not finding the next great investment. It's starting early, compounding at the best kind of average rate that you can sustain for the longest period. And if you could teach those lessons to people early on, people would, I think, avoid a lot of the bad habits of performance chasing and all of those sorts of things.
How do those media headlines you talked about and the constant market commentary make this worse for everyday investors?
Oh, it's a disaster. I mean, one of my podcasts that I do a version called Fix It Friday, which are 10 or 15 minutes, not of an interview like this one, but of me in a monologue about things that cause us to make bad decisions and how to overcome them. And one I did is how the media and big Wall Street firms collude to make money at your expense, meaning the investor's expense. So all these headlines, when you think about it, and that this podcast hits on your question. When you think about it, when you watch CNBC, the commentators have no idea how to advise people to manage money. They're not wealth advisors. But worse, they have no interest in it. Their interest is in sensationalizing as much as they can the stories of the day, 24 hours a day, to get clicks to increase so they can increase the ad revenues from the person on the right side of the screen who's from Goldman Sachs and the person on the left side of the screen who's from Merrill Lynch, because those two people are paying for the ads, by the way, right? That so, and they're trying to scare the bejesus out of my clients who are watching because they want to sell them these products that offer, more return for less risk. I call those products of the darkness, right? Because they don't exist, or whatever they're selling that day. And they'll be asked an unanswerable question. So the person on the left from Merrill Lynch is asked, "Is this 20% intraday decline during the tariffs last April? Is this the beginning of a bear market, or is it a buying opportunity?" I don't know. Flip a coin, right? And whoever it is you believe most, you're going to do. So, but what's interesting is there's a guy named Phil Tetlock who's recognized as having done, I think, the most widely respected research on the efficacy of forecasting. And what he found is that expert forecasters are right 49% of the time. So you flip a coin, it's just as efficacious. But what he found, and this is the worst part, is those people on TV. He found that the smartest sounding and the best educated and most intelligent sounding people are the ones with the least accuracy in forecasting. Yet those are the ones people are most likely to listen to. So that's the key. These shows and these people can destroy investors every day. Because what are you doing? Instead of compounding rationality and sticking to your plan in the face of the pandemics and the recessions and the Trumps and the Bidens or whatever it is that's going on, you're constantly changing the portfolio in response to current events and short-term market moves. We counsel people to do the opposite, to ignore that stuff and constantly and continuously act on the plan, never react to current events. You can feel the fears, you can be concerned, just don't reflect those fears by altering your long-term plan that's designed to get you to your objectives.
Stay the course.
And one other thing I'd like to mention to you, staying the course, is because it relates to your question in a practical way. So I'll get asked the question a lot when there's some crisis going on. In light of X crisis, Jonathan, what portfolio decisions are you having your clients make today? And my answer is simple, and this is for your audience. If you're going to be successful as a long-term investor, keep it simple. Doesn't need to. Leonardo da Vinci said, "Simplicity is the ultimate sophistication," and nowhere is it more true than investing. Buy index funds, diversified globally. In the last year and a quarter, international stocks knocking the cover off the ball. Everyone wrote them off for dead a year and a half ago. But at the end of the day, stay diversified. That means you're humble. You know that you don't know what tomorrow's leader is going to be, and if you keep it simple like that, uh, you won't be responding to all of the headlines. And you need more sevens than threes. This is the major point. You need stocks for the last 100 years. S&P 500 have made 7% after inflation. Equivalent investments in companies, similar companies in bonds, have made 3 after inflation. We need many more sevens than 3 to even have a chance. And so my answer is, what decisions are you telling your clients to make in light of the X crisis? My clients made all the decisions a long time ago when we decided we needed a lot more sevens than threes. This crisis doesn't change that. There are no new decisions they need to make.
Yeah, you've talked about before, because I was doing the research before the show, challenging some of those common assumptions of stocks versus bonds. Can you talk more about that? And why are those misunderstood, and what's actually risky?
Yeah, so it's from my perspective, right? So from my perspective, when you think about it, what's most important to the person who has money and wants to protect their money is what's most important to them. In reality, making sure that money doesn't have the number of dollars that they have in their portfolio doesn't fluctuate from time to time too much, or is it more important that the value of every one of the dollars doesn't permanently disappear to the tune of at least 3% a year? Logically, which one is more important?
Yeah, the latter.
Right? So if we say that the latter is obviously more important, then why in the world do we think that the industry has it right when they teach us our big risk is volatility, the temporary fluctuation in the number of dollars? And once you misdefine risk and safety that way, which to me is very misdefined, the solution has to be wrong. The solution is more bonds. We all heard of the 60-40 portfolio, and
Yeah,
particularly as you're going into retirement. Now,
right.
the average retiring couple is 62 in this country, and their average joint life expectancy, meaning one of them will live 30 years. You send someone into a 30-year retirement with 40 or 50% of their money in something that's going to freeze it in the face of 3 to 5% annual inflation that permanently eats it away, you're killing them. So the solution you're giving to the wrong problem, the illusion of risk volatility, the solution being bonds, is actually the carrier of the disease of money, which is inflation, because bonds freeze every dollar in the face of runaway compound inflation for the rest of your life. And a retiree, 30 years, a long time. So it's that simple. There's a guy named Harry Markowitz in the 50s who won the Nobel Prize, and he won it because before his work, of keeping this simple, you would compare a few portfolios historically and say, okay, which one looks more efficient? And so let me take this combination of investments because this one's more efficient. He said, no, we have to put a component of risk in each of those to compare one to the other, not just which one's likely to return more, which one has less risk. He chose the variable for risk to be variance or volatility. And because of him, I think from my perspective, he's singularly responsible for killing more wealth in terms of the dollars disappearing to inflation with that theory than almost anyone else, because the whole industry adopted his definition of risk, which is why you hear these products in the darkness, more return, that's risk, all this stuff. It doesn't exist. It just doesn't exist. I mean, I give you
Well,
one last example. When I was with UBS in the during the financial crisis, they were going to all the top advisors in the firm, telling them you have to buy these things called municipal arbitrage securities and collateralized mortgage obligation portfolios that were really AAA, which we know were not AAA. They were worthless. But the reason you should buy them is because they're not correlated with your equities, and they have a return of 7% a year and blah, blah, blah. Maybe they went to zero, right? So all this academic stuff about alphas and betas and correlation coefficients, when you go into crisis, betas go to one, meaning everything's moving the same way relative to the market. So all that stuff to me needs to go out the window. And it starts with Harry Markowitz's work with modern portfolio theory, teaching people that when you add bonds, you're reducing your risk.
I mean, I want you to talk more about that because when retirement and even midlife, 50s plus, right? When retirement's 10, 15, 20 years away, not just people turning 62, right? And one of them's got 30 more years. You don't want to do that, but that often brings heightened anxiety around money, not only because of they've got a portfolio in their 401k or their IRAs, but also because the likelihood of them losing their job probably goes higher in their late 40s and 50s and early 60s, and the ability for them to get a job to replace that income or a job at the same income level that they once enjoyed is also going down. So you kind of got this. I got my portfolio. I'm looking at retirement not 30 years away now, but 10 or
Right,
5.
right.
And stuff's going on at work, white collar recession. So there's a lot of heightened anxiety around that. And you mentioned the 60/40 and the bond problem that you see, but what other traps do people you see people fall into as they approach or enter retirement? I'm thinking of, people in bonds, right? To your point, keep up with inflation, but it was not going to support something. The second one I see a lot is cash. Hey, cash is making 4.25%
Cash is
if you're
king,
strong.
right? Cash is
Cash
king.
is king, right? Cash gives utility. Cash makes me feel warm and fuzzy at night when I, see a market blip. Like, what behavioral traps do you see people specifically fall into as they approach or they're entering retirement?
Well, it's interesting what you said. So my mentor is a guy named Nick Murray. And he always says there's something magical about the age of 50. When people get to 50, they realize they don't have more than 5 or 10 more years to make up for a lot of lost years when they should have been saving. And so they start to get panicky and they're wondering how they're going to do it and all this. So 50 is, according to his belief, a very magic age in the mind of people and their runway shortening to get to their retirement nest egg. I think, look, one of the traps is like trying to think that there's a correlation between how old somebody is and what's going to work for them for the rest of their life as an investor, right? So I'll give you an example. I spoke to someone in the last year who was in their mid 70s. And when I said to them my philosophy on bonds versus stocks, risk, safety, he said, "That all sounds good, Jonathan, but I'm 75. You know what I mean? I don't have that time horizon. I can take the risk of stocks." He still, defaulted to the risk of stocks. I said, "Well, what do you mean?" Because I had said to him, "It's not that I don't believe in bonds. I just don't believe that bonds should play the role of muting volatility. What role I think bonds should play is if we look back 100 years, the S&P 500 has gone from a peak to a trough and back to new highs. That whole round trip has taken 40 months on average. So as long as I have 3 years of living expenses to defend against when those declines come so that I don't have to sell stocks while they're temporarily down. I switch my spending after, let's say, down 20%, a normal bear market. I switch my spending to the side pool. And in 3 years, on average, I've gotten back to even and I haven't had to sell stocks at any meaningful loss at all. Better if I have $10 million and I'm spending 400,000 a year for my living expenses. And Jonathan says, keep 3 years living expenses in bonds. That's about $1 million too. I've got 90% of my money because of that strategy fighting the biggest threat to it, which is inflation, instead of only having 60% of my money fighting it because I've got all this extra bond money for the volatility. And so that's the big mistake, is correlating my age with what still works. So I said to this person who said, "Does it still work for me at 75?" I don't, I said, "Well, let me ask you a question. If I said that historically it takes about 3 years to go from a peak to a trough and back, which is why we have 3 years in bonds, is that statistic changing because someone's 50 or 75? Or is that just the statistic, right?" So you have to just reframe how you think about these narratives that have been fed to us our whole lives. And then one of the biggest killers of wealth for a lot who are probably listening is these target date funds in the retirement accounts, right? So these target date funds, what they do is if I'm someone who's 40, so my target retirement date is 65, right? That's 25 years from now. So I might have the target date 2050 fund. In that fund, there's way too many bonds. And so with these funds, is the older you get, and the bigger threat inflation is going to be to you, because your healthcare inflation costs as you get older are bigger than your other inflation, right? The bigger the threat, the more they programmatically and systematically move you from the 7% after tax investment to the 3% after inflation to the 3% after inflation investment. They're a programmatic, systematic killer of wealth. And yet over 50%, I think, of retirement plans are invested in them. Now, I have people who are invested in them. But what I do is if someone's got, whenever they're retiring, go out and buy the 2070 target date, not the one they tell you to buy, because that'll give you all the diversification across the stock components, international, U.S. small cap, without giving you dramatic bond exposure. And every few years, when there's a 2075, go to that one. Right. So this way you can still set it and forget it and be protected without killing your wealth, because it's giving you way too many bonds by age 50 in your retirement accounts that you're not touching until age 75 if you're 50.
Super interesting take on it, and one that I can absolutely understand. Let me go back to that.
Another thing I'll answer to your question, you asked about what other things. So my podcast coming out, I think next Friday, the Fix It Friday, I talk about avoiding the trap of cash accumulation. And
Yeah,
so,
hit it.
yeah. And you mentioned that. So
Yeah,
there's
do it.
four reasons people accumulate cash, in my view. One reason is legitimate, and that reason is I've got a fixed and determinable expense that I've got to save for. Taxes, buying my child a house, whatever it is. That's legitimate. You should save that cash. Once you've met someone retiring or anywhere else in life who's got more than 5-10% of their portfolio in cash, and you ask them that question, what's it there to pay for? And they say, we're nothing really. Well, then there's three other reasons it's there. It's one or a combination of the three. Either they have no plan. If you have no plan, the gravity that pulls your cash is the bank account. Two, you had a plan and it blew up or you abandoned it. So now gravity pulling that cash to the bank account. And three, and this is a tough one, is you accumulated cash for a while. And along the way, during the years of accumulating, you made either a purchase or an investment. And the outcome of that purchase or investment was so painful in a bad way that in order to avoid the regret, and regret is the most powerful emotion because long-term regret never goes away. It's the only emotion never goes away. So in order to avoid that regret, we revert to what's called status quo bias. If I just simply keep accumulating the cash, that thing will never happen to me again. So it's a combination of I have no plan, I abandon my plan, or regret aversion because I did something that really backfired. So now I'm going to punish myself by having substandard results for the rest of my life and go to status quo bias. So I just wanted to hit that one because that's an important one. And what your audience should do to avoid that is keep the cash they're accumulating for stuff they need in a separate account and keep all the other cash, and then say, okay, when my other cash that's not set aside, when it hits 10,000, 5,000, it goes to my investment. It goes to my, draw those lines in the sand so you don't fall into that trap.
You're making me think. I'm not pausing because I don't know what to ask yet, but you're making me think about my own stuff and my own biases.
Well, we're all guilty of this. Matt, I'm guilty of it. We're all human beings, right? So if people listen with an open mind, this stuff helps because we're all suffering from some, like I said earlier, the fellow who I mentioned who wrote The Psychology of Money, Morgan Housel. Behavioral finance often is when we're reading about problems and biases and things that big mistakes that we're reading about that we think all happen to other people, but they really happen and will happen if they haven't to us, right? And it's the same thing.
Yep. So let me go back to that topic, but also that 75-year-old you were talking about. I don't know. There's a part of me that goes, if I were 75, I would hope that I would have a plan. The old rotisserie chicken, I always talk about that commercial from the 80s. That set it and forget it. Like if I'm 75, right, still kind of messing around. Yeah. If I'm still tempted to do something with my money, I hope I'm not there, but I also know me and I know I'm different than, everybody's unique little snowflake. So For anybody listening, it doesn't really matter the age, but who feels tempted to constantly do something with their money, like what would you want them to understand?
When it comes to investing, you mean?
Yeah.
Constantly do something? Yeah,
Yeah,
I
with
look,
just their money, with their cash,
yeah,
with their bond, with their allocations, and who
well,
they listen to, and what do they do, and should I,
just
you know, United
keep it
Healthcare went
simple.
down 20%. Should I buy? Like,
Yeah.
just that kind of constant din.
If you're doing the things that you should be doing based on the principles I'm sharing, which is to say, hey, first of all, have a plan. That's the first thing. Most people don't have a plan. And a plan is not a portfolio. A portfolio is a servant to a plan, meaning it's the part that gets you that return component you're hoping to get, right? But the plan is, what number do I need to get to? What principal sum do I need to get to generate 200,000 a year when I want to retire at 60, so I can spend 200, grow it for inflation, and still leave a legacy for my family? That's a plan. Then, all right, so what's the best way to fund that plan? And one of my biggest threats to it, inflation and behavior are the biggest threats as far as I'm concerned. So get yourself a behavioral counselor. It doesn't have to be me. Get yourself a behavioral investment counselor, and then have your plan, and then understand that if I need a lot more than sevens stocks last 100-year return after inflation, then threes the equivalent return for bonds of loaning to those companies, then you've made your plan and you have your decision. Once you do that and you're retired, you have your 3 years living expenses set aside, there should be no news item. There should be no political item, geopolitical item that should convince you that the needs of your plan, which would have survived over the last 100 years, by the way, to make it successful through pandemics and recessions and the market halving 3 times in 73, 4, 2000 to '02 and '08 and '09, and 13 bear markets in addition to that, and 9 or 10 recessions since 1970, and interest rates as high as 20, low as zero, and Republicans and Democrats in equal numbers. If my plan made 10% a year in equities, 7 after inflation during that 100-year period I just described, right? And all I had to do to get that 7 was to buy the S&P, put it in a drawer, and elect to reinvest dividends. I would have gotten those returns. Most of the population doesn't get half of that return because they're constantly reacting to these things, and they're getting out thinking they can time the way out and then time the way back in successfully and consistently. It can't hardly be done one time. So people need to realize compound rationality, have a plan, understand you need more sevens than threes, and then tune all the noise out, because that's what it is. The signal is what you're interested in, and that's to me, the signal in investing is earnings, right? The reason the S&P 500 is at record highs is because earnings are at record highs, right? So it's not like a mystery. If you look back historically, you'll see that earnings and dividends grow 6% a year, and earnings are at record highs. So of course, the market should be at record highs. It's not because of the Fed making easy money or anything like that. That's all just narratives that are out there to cause people to question things. Should I buy all these new ETF products that are being created every?
What's your take on individuals, let's say non-professionals, doing individual stock buying? And I've read it all over the place. I personally, I don't buy individual stocks. Here's why: I'm not a pro. I don't have the experience you do. I would be guessing. The By the time I get information, it's going to be outdated and already acted upon. My job is my job, and my job is not, but stock picking. And so I kind of leave it to the index, and I leave it to the pros to help me as well. It's no different than, yeah, can I rehab a bathroom? Sure, it'd take me a really long time. Triple the time, double the money, and it wouldn't look very good. Or I can hire a guy who's done this for the last 30 years and everything will be done well. Kind of my take on it. But there are still people out there my age, older, younger, all the new platforms out there that 2 pushes of a button, you can go click. What would you say to the folks that do that? Do it, keep doing it. If you like it and you think you're good at it, would you put it at 10% of your portfolio, 0%, half? What's your take
Here's
on
what I
that?
say to people. Look, first of all, it's scary because when you talk about professionals doing it for 30 years. What is it? Most
Yeah.
professionals in my industry, the longer they've been doing it, the worse or if you're hiring them because they've been doing modern portfolio theory, alphas, betas, and correlation coefficients for 30 years. They're giving you 40% bonds to protect against the illusory risk. So the longer they've been doing it, the less I want to meet those people, right? So they're doing the wrong thing for 30 years, but they got 30 years experience. Well, what kind of experience? You need someone who's going to know the right things to do, however long they've been doing it. More experience, I agree, is better, but experience with the right things, right? Someone who's not practicing some form of behavior and who's thinks the answer is inside the portfolio more than in between years. They're just missing the boat. And so the point is, the people who do those things, who manage money, who pick stocks, professionals, you said pick stocks, right? Do you know the statistic over 15-year periods? Professional money managers, mutual fund managers, and it gets worse the longer you go out. 90% fail to match or beat their benchmarks, right? 90%. So they're spending millions of dollars annually on research and technology to try and do it. But the individual with all their biases who has none of that, is if they're going to do it successfully, come on. It's a waste of time, energy, and you're going to have subpar results almost every time. And you're going to have a lot of aggravation along the way. Now, think about when the markets get into panic situation, whether just the last 6 years, you had a 1 in 100-year plague roll in, caused the market to go down 34% in a month. Then the whole global economy shut down for a year. And then maybe 2 years later, when that started to feel like it was resolved, you had a 25% decline because interest rates and inflation spiked 40%, unannounced, unexpected. And then Russia invaded Ukraine. And then just a couple of years later, you had a tariff threat that caused 20. That's all in the last 6 years. But you know what else happened in the last 6 years? The S&P went from 3,300 to 7,000. And so you've got to understand, if you were nervous about all those things, the broad stock market, all of the companies aren't going away, right? But if you owned 5 stocks, oh my God, what if this company doesn't turn around? Well, you're out. You're out. It's worse because the panic is now individualized to these companies, which you can't possibly feel certain about as you could an index of companies. And so if the professionals can't do it, the first message is you can't do it. They're spending a lot of time and resources, but they're also human. Their biases are the same as yours and mine. And it's even worse because they measure their success oftentimes managers quarterly. So they're constantly looking to move. I mean, even in the mutual fund industry, there's a real term called window dressing. At the end of every quarter, they move in all the things that did well for the quarter. So when someone looks at their holdings at the end of the quarter, it looks like they did really well picking things at the beginning, and they sell all the stuff that did poorly, so that it doesn't look like they owned it. And so they're selling high and buying low systematically just for marketing. The advice is buy index funds and have a plan and have rules to your plan. And also, so this is helpful for people who are investing properly. When things go badly, meaning for whatever reason the markets go down, it's okay to feel the emotion. Don't reflect the emotions by changing your portfolio in response to them. And if it's really hard, get in your car, go to Starbucks, buy a coffee, go to the mall, go to the Apple store, buy a pair of sneakers at Nike, go back home and see how many packages from Amazon, and realize that the long-term enduring values of these companies didn't change a bit. It's just the price that changed. Separate the price from the value. Understand that everything that you're doing while the market's down 30%, ordering the Amazon, buying it, everyone else is still doing it. You use these products every day. That helps you separate like the stock market. We don't own the stock market. We own great companies. The stock market to me is the craziest place where some of the craziest people gather every day to react to some of these craziest things in the most illogical ways. That's not what we own. That's just not what we own.
That's a fantastic quote. I think I'm going to lead the webpage with that. That was awesome. Listen, if somebody wants to improve their financial decision making, let's turn this into action. If somebody is listening or watching and goes, yep, I recognize me in a lot of that. If they want to improve their financial decision making, regardless of how much money they have, what's the first habit or mindset shift they should focus on?
So the mindset shift they should focus on is to stop looking for certainty. Understand that I'm watching CNBC every day because human beings like to feel secure, and we feel secure if we know, because of hindsight bias. Oh yeah, I knew that would happen. Yeah, after the fact. Understand no one knew what would happen before the fact. No one knew the economy would close down for a year when the pandemic rolled. So before it happened. So just understand uncertainty is a condition in nature that doesn't exist. Certainty doesn't exist anywhere as a condition in nature. 2, have a plan. If you don't have a plan tomorrow, sit down and start making a plan. When do I want to retire? How much do I want to save? Do I value sending my kids to college? Do I have a 529 plan? How can I segregate my monies to accomplish some of these values and start that plan working? And lastly, understand that less is more when it comes to compounding anything. When you switch jobs 9 times, you're not compounding your career because you don't have a mentor who's taking you under the wing and giving you all the wisdom you need, right? So you're not compounding. It's the same thing. When you're switching your investments every year or two or three or every day, some people, you're not compounding the dividends and the reinvestments and the success of the companies, which happens not daily, but over years and decades. You've got to think long term and get all the short-term stuff, throw it out the window, you know? Try to go a few days without watching the financial news. That's a big help. Or surfing the net looking for, hey, when is the crash coming? Or, so something we call confirmation bias searches. Only will if you're convinced that the world's for crap because I hate Trump or whatever it is that's going on, and we're going down, you're searching every day why the market's going to crash under Trump. You never search why is the market actually likely to continue going up, the opposite of what you believe. So engage in non-confirmation bias searches to try and challenge the thoughts you have that might be holding you back.
Thank you. Last couple of questions here. This has been really fun.
Yeah, I'm
And
enjoying it
really
too.
and really interesting. What's the old adage, before you make a big decision, I think your mom told you, sleep on it. You know what I mean?
Right.
You wake up in the morning, or if you have a big purchase, people, I've heard this before, like if you're going to make a big purchase, put it off 48 hours, like wait. Yeah,
True.
that's kind of, the little mental tricks, right? But we're talking about mentality here and money. What is one question people should ask themselves before making any major financial decision?
Yeah. What are my most important values, right? And what role does money play or not play in them? And so if one of my most important values is family and friends, I mean, money doesn't really come into that. If it's education and I have children, then money comes into that, right? So start to try and align your decisions about money with your values, and then you'll make better decisions. Don't worry about the external. One thing I'll leave your audience with. This also came from Morgan Housel. So we live our lives, most of us, and I'm guilty of it trying to accumulate resume virtues. Jonathan Blau was the CEO of a big money management firm, and he left the Blau wing of the such and such hospital. Those are resume virtues, right? But yet when we die, we'd like to have eulogy virtues. We'd like people not to say those things. Say, "Hey, Jonathan Blau, what a great guy. He was so funny. He always helped people. He had the best family." So we pursue our whole life wanting people to look at us as if we had eulogy virtues, but all we do is pursue resume virtues. Flip it.
Interesting point. And going back, you've mentioned the word values a lot, and I have to assume that and plan, but a plan without the underlying values defined is probably worthless. Agree?
Yeah, I agree. I mean, one of the things I just helped a client with, they have a home, that's not in New York, and they bought a place in New York and an apartment, and they're kind of debating, "I don't know if I wanna carry these costs and do all those things." So I said, "Listen, when you're at a decision tree like this, where it's really hard to make the decision, make it easier." And, so I talk about making these decisions and Jeff Bezos says this, "Make decisions to minimize regret." Would you regret more if you sold your place where you live out of state, or would you regret more if you kept it but never had the New York apartment to enjoy? And then it became real easy to make that decision. They said, no, no, we would much more regret this. And so always make decisions when you're at a crossroads and you can't find a financial answer to minimize regret. And that goes back to values, right? Because what are you saying? When you minimize regret, what do I value more? Do I value more keeping my home or keeping my apartment? the same thing. It's another
And
way
the
of saying
underlying
it.
values underneath of that is family important to me? Is taking my walks in my old neighborhood or downtown New York
Right.
important to me? Like, you are making values call when you're trying to minimize that as well. Yep.
Exactly. It's the
Yep.
same way of saying that. It's a different way of saying the same thing. So, hopefully this was helpful to the audience, and, I certainly enjoyed well, I'm passionate about it, so I enjoy the
It
conversation
comes
with
right
someone who's
through. It's been a great conversation. Thank you. I appreciate I appreciate this perspective you're bringing, because it reminds people that financial success isn't just about predicting the future or, picking the right stock now or having the right ratio. It's about behavior and discipline and making thoughtful decisions when things feel uncertain. And they don't just affect portfolios; it affects stress, relationships, confidence, values that have to be defined, right? And ultimately, it's basically life, right? It's the kind of life people are able to live over time. Um,
Well,
this has been really fun.
My friend Doug Lennox, I'll leave you with this last thought. He said it to me on my podcast the best. He said, "You show me someone who's happy, and I'll show you someone who's successful. And I don't care if they live in a castle or a tent." And that says everything. If you have money, that doesn't make you.
That rings very true to me. Thanks for joining me today, Jonathan, and to everybody listening or watching. By paying attention to how you think and act around money, taking a smart step towards better wealth, deeper wisdom, and long-term wellness in every stage of life. Till next time, guys, thanks for listening and watching to the Matt Feret Show. I'm Matt Feret, and we'll see you next time.
Thank you, Matt.
Thanks for joining me on the Matt Feret Show. If you enjoyed today's conversation, please share it with a friend and subscribe on Apple, Spotify, and YouTube. If you're on Apple or Spotify, a quick rating or review really helps more people discover the show. For more resources, visit themattferretshow.com and sign up for the Matt Feret newsletter. And if you or someone you care for needs Medicare guidance, book a no-obligation consultation at brickhouseagency.com. Helping people make smarter choices as they age is my passion. This show is here to light the path towards your wealth, wisdom, and wellness. Thanks for being a part of the conversation.
The Matt Feret Show, related content, publications, and MF Media LLC is in no way associated, endorsed, or authorized by any governmental agency, including the Social Security Administration, the Department of Health and Human Services, or the Centers for Medicare and Medicaid Services. The Matt Feret Show is in no way associated with, authorized, approved, endorsed, nor in any way affiliated with any company, trademark names, or other marks mentioned or referenced in or on The Matt Feret Show. Any such mention is for purpose of reference only. Any advice, generalized statistics, or opinions expressed are strictly those of the host and guests of The Matt Feret Show. Although every effort has been made to ensure the contents of The Matt Feret Show and related content are correct and complete, laws and regulations change quickly and often. The ideas and opinions expressed on The Matt Feret Show aren't meant to replace the sage advice of healthcare, insurance, financial planning, accounting, or legal professionals. You are responsible for your financial decisions. It is your sole responsibility to independently evaluate the accuracy, correctness, or completeness of the content, services, and products of, and associated with, The Matt Feret Show, MF Media LLC, and any related content or publications. The thoughts and opinions expressed on The Matt Feret Show are those of the host and The Matt Feret Show guests only, and are not the thoughts and opinions of any current or former employer of the host or guests of The Matt Feret Show, nor is The Matt Feret Show made by, on behalf of, or endorsed or approved by any current or former employer of the host or guests of The Matt Feret Show.